Welcome, everyone. Thank you so much for joining me for today's webinar entitled New Year, New Plan. By way of introduction, my name is Monique Madan, and I'm a certified financial planning professional, a financial management advisor, and a chartered financial divorce specialist. I've been specializing in the area of personal finance for nearly 2 decades, but I have to say I came about it in kind of a unique way. My undergraduate degree was actually in neuropsychopharmacology, if you can believe it. And what that really means is it involves the interaction of drugs on the brain. But it has been pointed out to me since turning to personal finance early on in my career that having studied human behavior to some degree, although I would never pretend to be an expert in the field, but having delved into it and having a continued interest in human behavior could in very material ways affect how it is that I work with my clients. Personally, I just think as a fee-for-service planner that I just have the luxury in this chosen field of focusing solely on the clients and their goals because I don't sell any products. Since turning to finance early on in my career, as I mentioned, I've worked with those with high net worth and those who are very financially vulnerable and virtually every conceivable situation in between. In nearly 20 years of planning, then, I would say the people who can benefit the most from our work together are those who are, dealing with a particular question or a conflict between strategies, and they need some help prioritizing. And it's that impartial view that I can offer that helps them make a knowledgeable decision on where to focus their strategies. Professionally, I'm the head of financial life strategies at 2 business units under the Quintessence Wealth group of companies. One is called UPotential, and that's a fee-for-service financial planning firm. And through UPotential, we offer unbiased advice and strategy to Canadians. I also am very, very happy to be partnering with Larry Berman and his group at ETF Capital Management, where my services are offered as part of the suite of services for their clients. The interesting thing is whether you are paying for the service yourself through the fee-for-service UPotential business group, or it is offered to you by being a client of Larry's, it's the exact same unbiased messaging, the exact same unbiased strategies, where we look at everything from retirement planning, tax planning, and so on. The cornerstone of financial planning, it has to be money management, because without providing some discretionary income or some opportunity to save, we will invariably fall behind in retirement. And it's that money management that we're going to be focusing on today. So many of us have just celebrated a new year on January 1st, or those who practice Russian Orthodoxy on the 14th of January. And, being in a multicultural society, we're really excited that very shortly, February 12th, those of Chinese descent will lead us through their celebration of the Chinese New Year. And while the dates across the world vary, each new year brings with it an opportunity and a renewed interest in improving some aspect of your life. Now, frankly, we can't help but be optimistic about having a better year this year than we had last year. Am I right? And so it's this new year that brings with it an opportunity very often to make resolutions. And of the most popular resolutions, better money management often places third, only to losing weight and exercising more. So clearly, this is top of mind for many, many Canadians. But as we know, resolutions often fall flat within weeks. Over the holidays, I took the opportunity to reread a book that I really enjoyed called Nudge. It's written by a University of Chicago economist by the name of Richard Thaler, in conjunction with a Harvard Law School professor by the name of Cass Sunstein. Now, having mentioned my background, the book really took me back to my interest in human behavior as it applies to, political and economic goals. And most interestingly, it tackles the great divide between our intentions to do something and our success in following through. And what Nudge hypothesizes is that there are some strategies that can be implemented to encourage both growth and change. So I thought, I wonder if some of these lessons might better help me understand how to encourage better spending and saving when clients need them. Now, according to the researchers, change is hard for three identified reasons. Firstly, our memories are really short. So, for example, indulge me for a moment. Try and remember the last three transactions you did on a credit card. On the same lines, try to think of the last three transactions you did in cash. If that's difficult, imagine for yourself, and I can tell you I've certainly been in this situation. Have you ever made a what's called a stretch purchase? So something that is a little bit more expensive than you usually spend, but you deal with that dissonance that you can't afford it by saying, well, you know what, I'm going to scale down my spending for the rest of the month. But then when you look at your credit card statement at the end of the month, you realize that, you know, you hadn't scaled back your spending. So in fact, what you did is you enjoyed uh, a stretch purchase in addition to your normal spending pattern. And that is because ultimately memories are very short. There's also obviously, as human beings, we're influenced by outside forces, and the authors identify a number of them that impact our behavior. Now, these can be everyday distractions, or unforeseen financial emergencies, or even market forces like something like inflation over which we really have no control. One outside influence that's been talked about a lot recently is the fact that we have an entire generation of young Canadians who effectively have never seen high inflation or double digit borrowing rates. Now, that is, of course, if we exclude credit cards. The unexpected result of this relatively lengthy period of low interest rates is that we have an entire generation of Canadians for whom borrowing has always felt cheap and inexpensive. They also seem to have that influence affecting their investing because, again, we have an entire generation of young people who have never known a time where fixed income investments were ever worthwhile. And so that is something that, is an unexpected consequence of some of these outside forces. And finally, of course, there are temptations in every direction. There is certainly no shortage of ways to separate you from your hard-earned money. So, given that we can very easily understand why it's difficult to improve our financial position, now let's look at how we can influence ourselves towards a better future and a better year ahead. Toller and Sunstein give us lots of ideas on how, whether it's individuals or families or society as a whole, can be what they referred to as nudged in a particular direction. Some of the lessons that I learned from the book are as follows. First of all, Toller and Sunstein suggest that we commit to a strategy. The best way for the goal or habit to succeed is for you to commit the time and resources to understanding how it can be achieved and then not budging. Don't move until it's been set in motion. We're going to put down the foundation of that today. Next, Toller and Sunstein recommend that you automate the implementation. And in their research, what they found is that one of the obstacles to implementing a goal is how much mental energy it takes on a regular basis. So if we can automate a strategy and not have to think it through all the time or bring it forward every month or week or year, then it's more likely to be implemented. Let's use an example. So let's say, and I've just unfortunately learned how to do this, let's say you really want to set your PVR to record a program. You can do that in one of two ways. You can, find the program and set the PVR right then and there, or you can set it once and have it automatically repeat every time that program is on. What do you think is going to be more successful? You having to remember every Wednesday at 9 o'clock to either sit down and watch that program or set the PVR at 8:55, or to set it once and effectively forget it. Clearly, setting and forgetting will be more successful in the long run. And lastly, the author suggests that you decide in advance how and to what degree you're going to enhance your commitment by planning ahead for the next steps. These last two things I will set you up for also during this seminar. We'll talk about how you would go about automating the implementation and when to bring forward the tickler system. And that, of course, would be as infrequently as possible so that the plan can go ahead as designed. So my agenda for our time today is as follows. I'm going to help you to determine your maximum spending limit. This is the commitment that we talked about in the last slide. We're going to create an automatic saving strategy. And again, that's the automating, the strategy that we talked about as being so critical to it not happening once, but happening over a long period of time. And third, we're going to predetermine when to increase the strategy, in other words, planning for the future. Now, I have asked you to assemble some information. If you have, that's terrific. Rest assured, I'm not going to be asking you to share any of that with me. I'm just going to point you in the direction as we go through calculations where to find information so that you can follow along and do the calculations for yourself. So let's get started. We're going to start first and foremost with the maximum spending limit. Now, when we talk about a spending limit, I see my role as helping you to determine what your household can afford, a so-called affordability threshold. Now, while we're going to use a budget in the example, I don't call it a budget in sort of the traditional sense because it's not intended to limit your spending in the way that you've perhaps used that before. I'm not going to tell you exactly how much to spend on your housing or your entertainment or your eating out. Instead, what I'm going to give you is that hard limit and encourage you to create the best standard of living that you can within that parameter. Now, the reason that I don't give you specific budgets for items is because, values and tastes are very personal. So, for example, a lot of people are willing to spend more on their housing to reduce their commute time. You remember the time when we used to commute to work? Now, I don't know what that will mean in the future, but that was their choice and it was based on their value system, that their time is worth more than the extra money that they would spend on rent or a mortgage for a central location. Similarly, my husband and I have chosen to send our children to a private faith-based school that's quite costly. And what this has meant is that we've had to make other choices. We've had to forgo a larger home or fancy cars, and that's our choice. So what I'm going to do is I'm going to tell you how to determine what your income can support and then leave it to you to create your best life possible. When deciding on the maximum spending limit for your household, really you have to do three things. That maximum spending limit has to incorporate the costs of what you've already spent, in other words, outstanding debts. It has to leave room for taxes, and it has to leave room for savings because it's inevitable, whether by design or misfortune, at some point your income is going to stop. By design would mean that it was, let's say for a desirable um, goal like a retirement. But of course, we've seen incomes being interrupted for things that we could have never foreseen in our lives. So we must have savings as that soft place to land. One thing you might find interesting is that when we look at the maximum spending limit, we're going to start with your gross or before tax income. And the reason for that is because the taxes that are withheld at source often do not resemble what you should have paid in the end. The difference between what you should have paid and what is withheld at source is what would either be payable when you file your tax return or is refunded to you when you pay your tax return. So that's why we look at before tax income as the starting point. In other words, we're going to start before the money even hits your bank account. So, to understand the maximum spending limit, think of placing your before tax income into two buckets. The first bucket is going to be about 60% of your gross income, and that is designed to measure the lifestyle expenses and debt payments that you can afford. The other 40% in that second bucket is for taxes and automated savings. Now, why is it designed this way? Well, because if we link lifestyle expenses and debt payments, those two things are connected because the more we've spent in the past and are still paying for, the less we can afford to spend in terms of new dollars today. Similarly, because the most popular and very often the most effective saving strategy is the RSP, which gives us tax savings, obviously taxes and savings should be linked as well. So that's why we've kind of measured it out in those two ways. Now, what exactly do we include in pre-tax income? Well, we include two very important things. Firstly, the income of all adults who contribute towards household expenses. So in a two-income household, that would be two people. In a one-income household, it would be one person. And as you'll see in the next point, if you have adult children at home who are working, I would at least encourage you to take some measure towards having them contribute to the household. And I'll talk to you about why in a second. Essentially, the total before tax income that we're going to be using as our starting point should be the incomes of everyone participating in the household and all income streams in the household. Now, let's unpack this. Why should we include adult children? Because one of the things that I'm hearing anecdotally from clients is that adult children, again, in a generation that has never seen high borrowing costs, they don't always appreciate that not all of their income is discretionary. So what I would say is if you can ask them to contribute a small amount, whether it's covering their car insurance or contributing, a small amount of rent, that's a great lesson for them to see that that not all of their income is discretionary. Now, for those of you who don't need the money to cover those expenses, I would still encourage you to do so because then we can offer it back to the children when they're in a position to pay for a home. You can say all this money that you've, gleaned from them over the years, you've been saving on their behalf, and it's almost as if it's a forced savings strategy to help them launch and help them in their lives. Now, you'll see also that I'm including renters. And so whatever rental income you're collecting, let's say from a suite in your home or a basement apartment, whatever it is, I would include that as well, or any income that you earn from moonlighting. If you're a teacher, perhaps you tutor, whatever the case may be. And the reason for that is because it's incredibly easy when you have different sources of income to, on a day-to-day basis, say, well, I work so hard, I can afford a little more because I have this other source of income. And that's an incredibly slippery slope. So let's just assume for a minute that all of the income in the household is taxable and it's all going to be included in this particular calculation. So the strategy is to take out your pay stubs or the tax returns that I've asked you to assemble. If you're referring to a pay stub, you're probably going to have to extrapolate your annual income from the income that you earned in that period. So if you're paid monthly, of course, you would multiply that amount by 12. And again, it's the gross before tax and deductions amount that you're looking at. If you're paid semi-monthly, so in other words, on the 1st and the 15th or the 15th and the 30th, then multiply that number by 24. And if you're paid bi-weekly, so in other words, perhaps every other Thursday, multiply that amount by 26. Insert that amount for each spouse, and then we're going to multiply it by 60%. So while you're assembling that, I'm going to walk you through an example. Let's say we have Harry. Harry earns $62,000 per year, which, by the way, is just a smidge above the national average. And let's say Jerry earns about twice the national average, or $124,000 a year. The total for this household would be $186,000 in total household income, and 60% of that we're going to be focusing on lifestyle expenses and debt payments is about $111,600. Okay, now what do we do with this amount? It's a pretty nice sounding robust sum, $111,600. And it might be, but let's see how far it's going to get us. First thing we have to do is we have to acknowledge the payments that we are still making from previous purchases. So we're going to start with the debt payments. First thing we're going to do is we're going to include anything with a normal payment plan. So in other words, something like a car loan or a mortgage or a bank loan that has a preset repayment strategy, just use that amount. Okay. For variable loans, like let's say a line of credit or a credit card balance where you can pay all of it, and of course you should pay all of it, but if you are carrying a balance from month to month, what I'd like you to use is the minimum balance plus 3% of the outstanding balance. Okay, 3% is a nice fine amount of principal to repay, because that should get you on the road to repaying the balance in full within 3 years. Okay, so let's look at it in practice. We have lifestyle expenses for Harry and Jerry of about $116,000, and they've done a pretty good job. They just have mortgage and car loan payments, and let's say they're about $3,300 a month, which is $40,000 a year. So if we deduct the $40,000 from the $111,600, their annual lifestyle expenses are about $71,600. That's the amount that we're going to try to build a life out of. Next, as we're budgeting for your best life, the easiest things to put in are your fixed expenses. So this is typically related to your home or your car. You can pretty easily say, you know, I spend about this amount on gas and I spend about this amount on utilities. Those are pretty easy figures. What I'd like you to do is search up at some point a basic budget spreadsheet. And I have one that I'm going to show you in the next slide. They're available all over the place online. When you start putting in your fixed expenses, you'll see if it's a live document. In other words, it's one that adds together the figures and subtracts them from a particular sum. You'll see as you get closer and closer to that maximum affordability goal. That's what we're going to be building here. And then what you have to do is you'll add back the items from the fixed expenses that you've already predetermined. Again, those shelter and transportation costs. Then you get to cherry pick what's next most important and next most important and build your life that way. Okay, so as I said, fixed expenses like shelter and transportation are fairly easy to find. So let's say, for example, that Harry and Jerry, they have, let's say, their property taxes and they insure their property. They have maintenance of about $2,000 a year, and then let's say utilities are about $3,600. Their transportation, like I said, pretty easy to find. Their auto insurance is about $250. Let's say another $250 for maintenance a month, so that's $3,000 a year each. And then more or less maybe $100 a week on gas. Possibly a little bit less during the pandemic, but we want to make this a budget that can outlive the pandemic. Now, what you'll see here is I don't have the debts related to either of these two categories because we've already accounted for them. So in other words, mortgage, which would be usually related to shelter is not included here because we've already taken it into consideration. Similarly, their car payments, we've already taken into consideration. Next, let's build in some lifestyle enhancements. So basic personal, let's say they basically spend about $200 a week or $10,400 on food a year. Clothing, again, let's put about $2,500 for the year. Let's let Jerry have some hair and nail appointments. They have life insurance, so we have to put that in. They get some housekeeping help, so about $100 a week there, and they love their dog. So they're going to put some expenses or a budget there for their dog. Next most important to them, when I asked Harry and Jerry, they said they would really love to travel. So let's give them a nice, healthy budget for traveling, about $10,000 a year. And lastly, when we're looking at discretionary amounts, well, that's for Harry and Jerry to decide. And for our example here, let's say we're going to give Harry a budget of about $3,000 because he's a real fan of the Raptors. Okay, terrific. And then they've also decided that they'd like to plan for, gifts and Christmas, and between all of their kids and grandkids, in the future, they'd like to be spending about $5,000 a year there, which leaves us about $6,700, which they've decided they'd like to allocate to eating out. Relatively important to them, but in terms of priority, not as important to them, for example, as travel. That's why it was the last thing that we populated. And voila, we have a budget of totaling 71,600. That was our budget, and it's perfectly balanced. Now let's throw in a monkey wrench. Well, let's say that next year their daughter wants to go to upgrade her skills, and she would like $5,000 to help pay for, part of an MBA. She's $5,000 short. Where do we come up with that money? Well, we look at the categories again, and I would start with the last items that were placed in the budget. So I would look at the discretionary personal section here. You'll see I've added tuition. If we leave it alone and just say, we're not budgeting and thinking ahead into the future, the total needs is now 76,600, where our total expenses that we can tolerate are 71,600, meaning that we're over budget. I would much rather talk to Harry and Jerry now and say, okay, what are you willing to do without or reduce? And that's for them to decide. So we go through the exercise, they add things, they subtract things, they negotiate until they come to a budget that works for them. So for example, if Harry and Jerry wanted to give the $5,000 to their daughter, let's say we would look at the restaurant budget. It was the last thing that we put onto the budget. It was the sort of the least of the most important. They could decide that they would skim that a little bit, or maybe realistically, if they're contributing to their daughter's MBA, perhaps they won't spend a full $10,000 on their trip that year. That's for them to decide. The most important thing is that only Harry and Jerry, in this case, or you, yourself or you with your partner, you're the only ones who can make these decisions. As another example, my husband really enjoys concerts, but I'm not so keen. He can very happily have our entertainment budget. I'm most happy to give that to him. I'm perfectly content to stay home with the dog. But on the other hand, what really improves my standard of living is to have help around the house every other week. So he can have the entertainment budget and he gives me a little bit of a different discretionary budget so I can get some housekeeping. We give and take, and the most important thing is that in the end, we both have something that we are content and we can live with. So your homework then, as you go through this, is to commit to especially with regards to the variable loans, you want to make sure you prioritize repaying those within 3 years. And that was the minimum balance plus 3% calculation I gave you earlier. And then work through a budget of any sort that you like within the limit that we've established for you. And if you need to refresh your memory, this seminar will be recorded and you can always go through it and pause and do the calculations live if you couldn't do them together. Okay. The next piece of business is committing to an automatic savings strategy. So here's where I would have you again refer to a pay stub, and we're going to be focusing on the 40% that we haven't yet allocated. Remember, we only built the budget for debts and lifestyle expenses on 60% of your pre-tax income. This is the other 40% that we're going to focus on. So, referring to the pay stubs, look at the amount that you have, the total that you contribute to employment insurance, Canada Pension Plan premiums, and the taxes withheld at source. If you're looking alternatively, by the way, at a tax return, you're going to refer to the total payable line, which is the last line on the page that calculates your total income. Or you can also refer specifically to line 132 on the T1 General. Again, if you're looking at a pay stub, you'll have to extrapolate based on the number of pay periods per year. So multiplying that figure by whether it's 12, 24, or 26, as we've done before, and that will get you to the total amount that you're paying in taxes in a year. We'll then set the saving strategy as follows. The 40% amount that we have not yet allocated, less your taxes payable, will be your savings target. And then what we're going to do is we're going to set up an automatic withdrawal of that savings target. So let's look at a calculation. For example, when we're determining the savings target, let's go back to Harry and Jerry. Their total savings and taxes amount, so 40% of their gross household income, is $74,400. That's the amount we had not yet allocated. Now, for example, let's say on Harry's pay stub, he has deduced that his CPP, EI, and taxes comes to about $18,600. Jerry, being a higher income earner, let's say hers is about $37,200. If we subtract the amounts that were withheld at source for taxes, CPP, and EI for both of these spouses, the difference is $18,600. This is what their target saving strategy would be. Now, let's say, for example, that Jerry is paid biweekly, and we would like Jerry to direct the savings. We would then determine what the biweekly amount is. So in other words, 18,600 divided by 26. So we've decided that we're going to set up an automatic saving strategy of $715 a month from Jerry to some goal, which we'll direct in a second. Now, very importantly here, if you find this hard to follow, this may be more important than doing the budget the exercise that we just did. Because if you can set up this biweekly saving strategy and just not go into debt, you will by default be living within your means and by default be spending at or less than 60% of your gross income. So if you couldn't do the previous calculation, this one is even more important. Okay. Now, where are we going to direct these savings? If you don't already have an emergency reserve, which is usually 3 months worth of expenses, I would direct that money to a joint savings account that is earmarked for emergencies. Now, first of all, if you have been able to prepare the budget in the previous section, then you know how much 3 months of your expenses is because it's your total budget divided by 4, okay? What you will then do is you set it up specifically to a joint savings account because there will inevitably be a time in your life where one of the two spouses who is responsible for covering expenses may not be able to get to the account. And that could be because of illness, because of injury, for whatever reasons. Maybe they're abroad, for whatever reason. It's really important that your emergency reserve be accessible to both spouses. Now, if you already have an emergency reserve, the next best thing would be to set up an automatic savings plan to the RSP of the higher income spouse. You could, if you wanted, direct the savings to a spousal RSP, but to be fair, those are not quite as necessary as they once were because of some modifications to taxation during retirement. Still helpful, but not quite as crucial as they used to be. Now, if you're contributing to the emergency reserve, again, remember, make that joint money. And if you're putting the money into an RSP, let it go from the higher income earners checking account to their RSP. This may seem a bit technical, but the truth is that it's frowned upon for an RSP contributions to not come from the person who earned the money. It's subtle, but I don't also want you to be vulnerable in case of audit. There are some exceptions. What if you've gone through the exercise of going through 60% of your budget and then implementing, your debt payments first, and then you find that you can't cover your basic needs of life? That means that we're putting too much pressure on your cash flow to get out of debt within 3 years. Well, try your hardest because this is really important. The sooner we free up the consumer debts of the past, not necessarily a mortgage or a car payment. Remember, anything with a preset repayment plan can continue as it was. This is for discretionary payments like lines of credit and credit cards. It would be really great if you could get out of debt within 3 years. But if that's too hard, you can inch it away from there. Let's say try 3.5 years. So that calculation would be the minimum payment and 2.4% of the principal instead of 3% of the principal. Or if you need to go even a smidge further, 4 years. So that would be minimum payments plus 2% of the outstanding balance. The sooner the better, but if it's simply too hard, yes, you can inch yourself away from that. What if also your taxes, CPP and EI contributions end up being more than 40% of your gross income? In other words, there's no room for savings. Well, double check because that would really mean an extraordinary income. But if that was the case, then what I would say is I would reduce the spending amount by 5% and let your taxes and savings budget be 45% instead of 40. If this is the case for you, I'd also really, really recommend that you speak to an accountant because there may be ways of reducing your tax burden. So your homework in this section is to set up an automatic savings strategy. Okay, and I've shown you how to do it. And again, please revisit the calculations if you'd like and go through it. It's a fairly easy thing to calculate. Lastly, we're going to, again, let's try to avoid the cognitive dissonance involved in having to redo something monthly, weekly, or quarterly. Let's decide ahead of time when we're going to make these changes. So if we're going to adjust those strategies, let's determine when to adjust them in advance and by how much. So for example, I would always use a cue from your income. Most Canadians, or in fact, anyone earning more than the national average, which I had told you earlier was just a little bit lower than $62,000 a year, will have a point in their year where their CPP and EI premiums are maxed out. For example, if you're earning $100,000 per year, this is going to happen sometime in the middle of the summer. You'll see your take-home pay artificially increase. If you're earning a little bit more than that, let's say $150,000 a year, that's closer to maybe the end of April, you'll see that change. That is a perfect time to increase your savings strategy because you've already budgeted based on the CPP and EI premiums. If they aren't being allocated to spending in the first months of the year, you've already established a pattern. You might as well increase your savings by that amount. You're not going to miss it. Or you can also set a tickler for yourself, which again, I would try to make as infrequent as possible. It could be at the beginning of a calendar year, right? New year, new plan. Or, if you're self-employed, a fiscal year end, or if you work for a company that has a fiscal year end that would often give you a raise at their fiscal year end, coincide it there. Doesn't matter insofar as you've kind of you've predetermined how much you're going to increase your savings by, and you know when, and all you have to do is click it. Okay. If you don't have, you're not yet earning CPP and EI, or in excess of the CPP and EI premiums, or you don't want to do it at a predetermined part of the year, you can do it once a year and just use a default amount of 2 or 3% so that you're increasing your savings in line with inflation. So the homework here would be to set a tickler in your calendar on a predetermined date for a predetermined amount to increase your savings by. In summary, we know that the total household pre-tax income is going to be divided in two pots: 60% for debt and lifestyle, 40% for taxes and savings. Then you're going to take that 60% figure, allocate your debts first, and that becomes your affordable household budget. Similarly, the 40% less your CPP, EI, and tax figures is going to be your savings target, which can either be directed towards emergency reserve or retirement planning. And lastly, you're going to set it up on an automated schedule and either forget it or at the very least adjust it. Okay. If this was helpful, please join me next time, which is scheduled for February 16th. It's a Tuesday, just like today, for our not so well known RSP strategy seminar. And before I let you go, I will look and see if there are any questions. But if there aren't, let me just see quickly here. No questions. That's perfect. So we've been clear. If I can be of any help, or if you have any questions about the content of this seminar, please, please, please don't hesitate to reach out to me. Here's all my contact information through UPotential, my phone number, my email, and the UPotential website, on which you can find other seminars that we've recorded. And I do appreciate your time and attention today. Please, it would be my pleasure to help in any way that I can. Thank you so much.